Okay, so we are going to work some exercises from chapter 5, and this is going to help you learn how to do adjusting entries better. All right, so the first one we're going to do is exercise 5.6a, and I think your homework problems this time, you have a couple of B versions and a couple of A versions, and that's because I was trying to get you some experience with the ones that are similar to your Excel sheet. And so I just work it however I can to make it come out where you get some exposure to all the things I think you're going to need. But anyway, so we'll do a couple of A's and a couple of algorithmics, which is just where they generate some new numbers for us, but we do the same kind of problem. But so you should be totally capable of doing your homework, including the Excel when we finish. So the first one's going to be 5.6b. And basically, they're telling us if you had this amount of supplies in your supply closet, and then at the end of the period, you're trying to tally it up and correct your records to where they match reality, then what would you need to do to make the journal entry for the adjustment so that your financial statements will be correct? So the first one says, analyze each situation for supplies and indicate the correct dollar amount for the adjusting entry. And the T accounts is what they're having us use for the adjustments this time. Rather than making the journal entry, we're going to post the journal entry to the T accounts just to get some experience with how the adjustment works. Okay, so the first scenario said ending inventory of supplies is 260. And if you look at your T account for supplies, you can see that your supplies account has a balance of $560 debit. So that's like there's a supply closet somewhere that has all the supplies you've needed for this period. And when you buy them, you just always record it as supplies. Like there's a big closet with all of them in it. When you need some, you just go there and grab some out. So there's two ways they could tell you how much to adjust it by. One is they could tell you how much supplies are still there at the end of the period. And then you would know the rest of them that are missing are the supplies expense. So that's what the first one is going to, this first exercise is going to do. The second piece of the exercise is going to just tell us how much of the supplies were used up. So both cases can lead you to the correct answer, but you just have to look closely at what they're telling you. If they give you the ending balance of the supplies account, they're trying to say everything that's missing from the supplies inventory is what was used up. And so therefore we'll put that used up part as expense. So that's what we're doing with this one. The balance was 580. So I got my little trusty calculator here. So the balance was 580, and I subtract from that the 260 that they say exists at the end of the period. That's what it is. Well, if I could just key it into my calculator correctly, it would make it a lot easier. 580, Janice, minus the 260, which it should be. So I want to adjust the account to this balance. So if I have a debit balance of 580 and I want the ending balance to be 320, 260, then I need a credit to reduce it by. So we already know that when you tally up an account, you take the debits and credits and you tally all the debits, all the credits, and net them out to get you your ending balance. So we had a $580 debit balance. We're going to post a credit of $320 to it, and that is going to leave our balance at the correct amount of 260. So I didn't have to go through all that with the calculator and all the business, because I can just look at that and say, well, if I want the ending balance to be 260, then I just have to give it a credit of 320, because I need a credit that can eat up part of my $580 debit balance and leave it with a balance of 260. And so that's all you do. When they tell you the ending balance, you just go straight to it and say, now, how do I get this balance from a debit of 580 down to its actual balance of a debit of 260? And the only thing that can make a debit balance go down is to post a credit to it. And so we knew we were going to post a credit. All we had to do is subtract 580 minus 260, and we would know the amount that we need to credit for, and that's that 320. Okay, so when we made a credit entry to supplies, then we also have to make a balancing entry. So we'll make a debit entry to the supplies expense, because the amount that got used up is the supplies expense. So every time you make an adjusting entry, two things are happening. You're going to toggle between the expense account and the asset account or the liability account, if that's an asset, it's represented by a liability. But there's going to be there's going to be an entry to a balance sheet account and an entry to an income statement account. And the partner account is the only one you consider. Like if supplies are gone, there's only one place they have gone to. They went to supplies expense. Just like when we do one about insurance, when insurance is prepaid and as it is, you pay in advance, then if it's not prepaid anymore, then it is insurance expense. So that's the same thing. You got a little partner account with every one of these accrual accounts. So a supplies, when you record them, you don't show them as supplies expense, you show them as supplies the asset. And then when they're used up, they transfer only to supplies expense. So that's that little toggle between, is it time for it to go to the income statement or should we keep it on the balance sheet? Supplies is on the balance sheet. We shift it to the income statement when it's time to recognize it as an expense. So that's what we just did. Okay, so that's one way they could tell you what's the new balance and you adjust to that new balance. The other way they could do it, for example, like this example 2 of this exercise says they just are going to tell us in this, it's a fresh scenario. In this scenario, there's the T account has a balance of 435, but the information they gave us is the amount of supplies used is 230. So if you know the amount used, you know the amount that is expensed, because when it's used up, it's time to show as an expense. So the part we know best about that one is that supplies expense is going to be 230. So on this one, we are going to debit supplies expense for 230, 230, and we're going to credit the supplies account for 230. And that's going to leave us with an ending balance. And again, my calculator here, 435 minus 230. If 230 was used up, then what's left that's still in the supplies account or still in supplies closet, I'm trying to match reality with what shows up on my accounts, is 205. So I look at that, I think, hey, this looks right. I think it is good. I'm sorry, I'm just going to move my little screen over here a little bit. Let's try to get it out of the way so I can check my work. And when I check my work, I see all the check marks are correct. I'm like, yes, perfect. I'm good with that one. So if you had any question about that, just go back and watch that part again. Otherwise, we're good. Let me see if I can drag this little thing out of my way. There we go. All right, so that was the first one. That was 6A, and really simple. You just, once you understand it, it's good. Same thing with 7. We're going to do the same very thing. We're going to make the adjustment to the 2 accounts that are affected when you have an insurance prepayment. It means it's something that's going to be affected. It's going to turn into interest expense because that's this little partner account. It's a toggle that we're doing between prepaid insurance and interest expense. We just have to look at the data in the problem to see how much of it should stay in prepaid and how much of it needs to move to insurance expense. So for this one, 2 parts again, because there's 2 ways they could tell you. The first one says the amount of the insurance expired is $970. So when they say how much expired, they're asking you to record that much as an expense, because prepaid insurance is unexpired when it's sitting in your prepaid insurance account. When you first write the check to your insurance company, it's not an expense, it's an asset because it's insurance premiums for a future period. So that's not going to be an expense until it expires. So that when you record it to prepaid insurance. When it expires, you take it out of prepaid insurance. So what we've got here is we've got the balance sheet showing up with, at the time we're making the adjustment, which is at the end of the period, right before we do our financial statements, we're going to make an adjustment. And that's what this whole chapter is about, is the adjustments. And so prepaid insurance has a balance of $1,450. They tell us that $970 of it expired. That's telling us reduce the prepaid account by $970 and shift it over to the insurance expense account. So your 2 little accounts that are partners are prepaid insurance and insurance expense. So if you make a credit entry to your prepaid insurance with your adjustment, your debit's going to go to that insurance expense. So that one is a piece of cake. So all we have to do now is say, well, how much is left in prepaid insurance? We started with $14.50. And so we had a debit of $14.50. And we credited it for $9.70, which reduced the balance, of course, to $4.80. That's all for that one. Now, the second part is a different way they could have told us. For a different scenario, it's not the same account. This is what if your insurance company said this? Your insurance account said this. Prepaid insurance right now is sitting with a debit balance of $13.50, as you can see right here. And so they're telling us the unexpired insurance is $565. What they're saying is the prepaid account should match the amount that's really still outstanding or still not expired. So $13.50 is what we have on our books. It's wrong. At the end of the period, it should be $565, right? Because that's the amount that's unexpired. Sorry. So if we need to take the balance from a debit of $13.50 down to a debit of $565 so that the prepaid account will be correct, that means we need to say, how much of a credit do I need? $13.50. I need it to go down to $565. So of course, I'm just doing my calculator. I need to credit it for $785. Okay, so if I'm going to credit prepaid insurance, I'm going to debit something. I can't debit some random account. I have to only debit the partner account that goes with it. Because when this prepaid insurance becomes expired, it automatically becomes insurance expense. So I'm going to debit insurance expense for $785, and I'm going to hope my math is correct. So here I go checking it by check my work. Check marks. Yes, check marks are my friend. I like that. Okay, now, so everybody's good, right? And again, anytime you have trouble, just watch them again until you clear it up. All right, so now what we got? Okay, we're going to journalize some adjusting entries. They've given us a worksheet. This is 510A, and this is an algorithmic version, which means they just gave me some new numbers, but you're going to have one of these like this in your set. Okay, so this one shows the worksheet, and as you know, on the worksheet, it has the accounts that you're dealing with that are existing for the client. It's really just a list, kind of like the trial balance. It is a little trial balance. The worksheet starts with the trial balance embedded in it, and then it lets you show the adjustments there in the worksheet, and then it brings a new trial balance up that's called adjusted trial balance. So I call that an ATB, because that's what how a lot of people refer to it. So when you see a worksheet that shows, here's the account names over here to the left, then it shows the trial balance amounts for each of those accounts. You see how they equal the debits and the credits, $57.40 for both. Then it's got the adjustments. Now, there's a couple of things they could ask you to do. They could ask you to say, okay, here's your trial balance. Now, these adjustments need to be made, and they could give you a list of adjustments, and they would want you to do these adjustment entries in the debit and credit columns. And then they would probably say, and then pull an ending trust trial balance. So then you would just also restate your trial balance after these adjustments. So that could be something they would ask you. In this problem, though, they already did the adjustments, and then they pulled the adjusted trial balance by just changing the balances to what they are after the adjustment. So you notice that cash has a debit balance, and it still has a debit balance because there's no adjustment made. But supplies had a $900 debit balance. It took a credit of $600. So the ending balance is only $300 in this case. And every one of them is like that. If there was an adjustment made, it changed the trial balance amount to the reflect that adjustment. So that's all this is. So then when you look at the adjusted trial balance, again, you see debits always are going to equal credits. So that's where we are. That's what they gave us. They gave us an adjusted trial balance worksheet. Okay, now let's see what they want us to do with it. From the adjustments column in the worksheet, journalize the 4 adjusting entries as of December 31st in proper general journal format. So nothing to it. We already know that we take close out, I'm sorry, not close, that's next time. We adjust each entry for the its partner adjustment. So we're going to just go down the line here. The first one we're going to adjust. I got to see which order they did. I'm sorry. Okay, so the first one they did was the supplies account. So you see how the supplies account took a credit. So we should not put that on the first line because debits go on the first line, right? We're going to take the supplies account as a credit for the second entry. And its partner account is what we're going to put for the first entry, or the first line of the first entry. Both of them are the first entry. Line 1 and 2 are the debit and the credit accounts of the first entry. So we have supplies, and it was a $600 credit to the supplies account, and a debit to match it, that it is supplies expense. So that's what happened. If you look, you can see supplies expense took a debit of 600. Supplies took a credit of 600, right? So you good? The next thing that happened, if you just go down the line, prepaid insurance had an adjustment of $630. Whatever part you're most comfortable with, you could enter that first. You know it's going to have a balance entry, so I'm going to go ahead and put the debit in there too. And I'll look back and say, now what did they do? It was prepaid insurance. They credited that one. So I'm not going back and thinking back through, what entry do I make again? No, I've already got them. I'm looking at it in the trial balance. I don't have to reanalyze what happens when you make an adjustment. I can just look up there and see, oh, it's a credit to prepaid. So I know that's what the entry was. And then I pull its partner account, insurance expense, and it would take the debit. And as you know, I don't really like their format because I want them to give me a little indent on my credit accounts. And they haven't done it. So again, but it's okay. I can live with them. But you know, if you're really doing it, you would credit, when you credit an account, that account name would be indented slightly. Okay, so now the next one. Let's look and see what else happened. Accumulated depreciation has a credit of $600. $600. Accumulated depreciation. And the partner account for accumulated depreciation is always going to be depreciation expense. The amount is going to be the same because each entry has to balance. So far we've got 3 of them. We need one more. Wages payable, a credit of $100. 100 for wages payable. The partner account to wages payable is wages expense. So it looks beautiful. Let's see if they agree with me. I'm going to check my work. Yes, the check marks all over the place. So we're good. All right. The next one we're going to work on is problem 14A. This one is similar to your, no, it is the same problem. It's just kind of different numbers as your Excel problem. So they're wanting you to do the worksheet. So like I mentioned a moment ago, they want you to adjust based on these different scenarios of what happened that needs some kind of adjustment. Your balance sheet or your trial balance so far is already in here. You got 15.6 in debits and 15.6 in credits, and they have every account that exists on the general ledger. So then they're telling you the only ones that changed are these 4. And so they said supplies inventory changed as of December 30th by $90. Let's see if this is going to make us do the journal entries. But they are actually not asking us to do the journal entries. They're just wanting us to post it to the worksheet this time. So we're going to do them as a post to the worksheet, the journal entry. But the easiest way, in my opinion, is just go ahead and make the journal entry. And that way you would know exactly what it needs to be. But so if I were doing it, I would just take a pen and write out the journal entry for each one and then post that to these accounts. Okay, so the first one, supplies inventory as of September 30th is $90. So I go, supplies inventory. What is supplies? Oh, we're showing it as 600. Okay, so I'm going to need to adjust that so that it'll wind up being $90, right? So what do I need to do? I've got a debit of 600, and I need it to be, I need it to be $90. So I have to credit it by 510 in order to get that to happen. So the next thing that happened, I'm only doing the ones that have an adjustment. The next one says insurance expired, was used up of $325. So if insurance, I'm sorry, I should do the other half of my entry on my $90 while I'm at it. So the 510 I credited to supplies, I'm going to debit to supplies expense. Sorry. My phone was dinging and distracting me. Okay, so far we just made one entry. We credited supplies, and we debited supplies expense for 510. That was because of this first instruction they gave us. Then the second one, interest, it was expired for 325, means we're going to reduce prepaid insurance, 325, and we're going to debit insurance expense for 325. Okay, that's the second entry. The third one, depreciation on the delivery equipment. Every time they give you depreciation, they want you to debit depreciation expense. They want you to credit accumulated depreciation. It's not going to be different. Later on, we'll learn more about in other accounting classes, probably in this accounting class before we're done, we'll learn about how to calculate depreciation. But right now, they're going to just tell you how much depreciation is. And it means that every time you see that, you say, easy money, because all I do is debit depreciation expense. And I credit its partner account accumulated depreciation. So 1280 means I'm going to debit depreciation expense for 1280. I'm going to credit that partner account accumulated 1280. And then the fourth one, wages earned by employees but not paid as at the end of the period is 370. So we got wage expense of 370 and wage payable as a credit of 370. This is a liability. We owe these employees that extra wage. Okay. So I have entered an entry for each of these 4 transactions, and then I'm ready to go ahead and complete the schedule. So once I've made the adjustments, I can then just go ahead and post what's the new balance of each of these. I had already pre-done the adjusted trial balance and the balance sheet entry for cash. Let me get this over here. It's a little bit, since I'm only working with the worksheet and we can see it better. All right, so I had already done the first line. Cash didn't change, so I just moved it over to the adjusted trial balance just like it was. And then I know cash is on the balance sheet, not the income statement. So I carried it to the balance sheet columns. Same thing with accounts receivable. I know I didn't change it, so it's going to be $1,000 debit still, and I know that's an asset. It goes on the balance sheet. The next one, supplies. I adjusted it down to 90, and that is an asset. It is going to land on that balance sheet. The next one, prepaid. I didn't subtotal this one yet. $1,300, and I credited about $325, which means I'm going to be at $975 now. That's my ending balance of prepaid. And it goes on the balance sheet. I didn't change the delivery equipment, so I'm just going to bring it on over to the adjusted trial balance. This adjusted trial balance is just where I'm restating the balances of each account based on whatever its balance was or its balance plus or minus the adjustment I just made. So we didn't change this one for delivery equipment. So we just carry it over to the balance sheet because we know that's assets. As a matter of fact, you know all the first entries on the trial balance are assets all the way down till you get to the first liability. So even accumulated depreciation is in the asset section. It's what's called a contra asset. So accumulated depreciation delivery gets a credit entry of $1,280. And it carries over. You got to be careful. Make sure you keep accumulated as a contra asset. So it's a credit balance account. So now the ones I have now already posted are the only assets we have. It stops at accumulated depreciation. And then we start talking about our liabilities. So accounts payable is $1,230. And it didn't change. We didn't make an adjustment to accounts payable. And then wages payable. There was no balance originally, but we entered an adjustment. So we do have balance now, $370. And again, these are liabilities. They have to go on the balance sheet also, don't they? But we're going to be posting things to the balance sheet area until we finish with all the assets, liabilities, and the equity accounts, just not the revenue and expense accounts, as we know the income statements where those go. All right, so the capital account, $8,070 as a credit. That, of course, we know is part of the balance sheet, the equity section. The drawing account, it did not change. It's a contra equity account, $1,400. It's going to stay also on the balance sheet because it's not revenue or expense, so it can't go on that income statement. All right, so that is all of the balance sheet accounts. So this should be right. And so if we check my work now, I don't know how many check marks I have, but hopefully I got it one more. See if there's anything that comes up with a tilt. No, look at all those beautiful check marks. That makes us so happy. So far, so good, right? Okay. All right, so next thing. We are down now ready to deal with the income statement accounts. We have a credit to delivery, 6,300. So we didn't make an adjustment to it. So we're going to go ahead and put a 6,300 credit, and it's going to be moving to the income statement as a credit. And then the wage expense, it was 1,500. We added 370 more. So now it's 1,870. And that's an expense on the income statements, which is a debit. Well, it's a debit because it's a debit right here. This is a debit balance. We added more debit to it. So the adjusted trial balance wound up being a debit, and that's why it's going in the debit column on the income statement also. Okay, and then the advertising didn't change. So it's still 450. And advertising expense, every expense goes on the income statement. Every revenue goes on the income statement. And so then rent expense, we didn't change that one either. So 750 and 750 on the income statement also. Now, supplies expense had no balance in it, but we entered 510. So now our adjusted trial balance has 510, and that is an expense on our income statement. The phone expense is $200, didn't change, goes on the income statement. Interest expense was not there, but we posted an adjustment to the account. So we toggled some of the insurance that was in prepaid insurance over to the income statement because it had expired. And so 325 is going to be an expense. Gotta touch it first. 325 is an expense on the income statement. Repairs expense, no change. So it's still a debit on the trial balance, and that means still an expense on the income statement. Oil and gas expense, no change, still a debit on the income statement. Depreciation expense had nothing, but we made an entry that recorded depreciation expense. So that's a debit in the trial balance, and it's a debit in the income statement. So now we've posted everything, and might as well just check one more time, make sure it's all good. See anything that doesn't have a check mark, then you go back and say, okay, I did some silly thing. Let me fix it. No big deal. All right. So now let's look at this and let's add up all the debits and all the credits for each of these columns so we can make sure it stays in balance. So for the adjustments, the debits were, okay, I got my little calculator. The debits, this is a tricky part since this is I don't have the answer key. I'm just doing it because this is an algorithmic generation. 370, a 1280, and a 325, and a 510. I think it's 2163. Oh, okay. I'm gonna write that down. I'm gonna do the other side before I key it in. All right. I went up on one and I'm going down on the other one. 370, 510, 325. 1280. Yeah, it's not 2163, it's 2485. Here's the thing, if you add it 2 or 3 times and you get the same number, you probably got it right. A lot of times we can find an error by just adding the numbers again because it's just some little keystroke on your calculator. 2485, that's the same number twice, so I'm gonna feel very comfortable with that one. I'm just gonna go back and add this other column that I did not get that number for. Okay. So the credits on the adjustments column now, 510 plus 325 plus 1280 plus 370. Yes, 2485. This is a good thing about that makes you feel good about accounting because you get the balance. Okay, so we're agreed on those two. Now let's look at the adjusted trial balance columns. We're going to add those up. 1,700 plus 1,000. Plus 90, plus 975, plus 6,400, plus 1,400, plus 1870, plus 450, plus 750, plus 510, plus 200, plus 325, plus 220, plus 80, plus 1280. Now we hold our breath and see if the other side comes to the same number. 17,250 is what I got so far. Let me try the other side, the credit side of the ATB. 1280 plus 1230 plus 370 plus 8070 plus 6300. Is that all? Oh, bull. I just added. Oh, yeah, it is right. Sorry. It is correct. Sorry. I thought I messed up. 17,250. See, this is fun because me doing it without the answer key because it's algorithmic means you get to see how I actually have to wrestle with it too, just like you do, because you just wade through the process and sometimes you get a key error and you just go over it again. No big deal. Okay, in this next column, income statement, I'm gonna do the credits first because they're so much easier, just one entry. So I can just pull that entry down. And then the debit column, I'm gonna add up my expense list. I got 1870 plus 450 plus 750 plus 510 plus 200 plus 325 plus 220 plus 80 plus 1280. Well, that's not right. I added one of them in there incorrectly, obviously, because it's a huge number. Okay, try again. 1870, 450, 750, 510, 200, 325, 220, 80, 1280. 5685 is what I have right now. See if I'm right. Yes. Okay. Oh, all right. So let's go ahead and do the other one, the balance sheet, and then we'll come back and finish this. You better came out all at once. Let's see which okay. All right, so let's do the balance sheet piece. 17 for the debits, 1,700 plus 1,000 plus 90 975 6,400 1,400. So I think we got 11,565. And again, I'm doing this on the fly because if I can't do it in advance because when I open it again, it gives me a whole nother set of numbers. That's the beauty of algorithmic. Okay, for the credits, 1,280 plus 1,230 plus 370 plus 8070. That might be wrong because I did have to adjust one in my head, but we'll see. Okay, so what we have is we have a net profit here. Looking at the income statement, $6,300 income minus the expenses of 5,685. 615. And then on the balance sheet, 11,565 minus 10,950, 615. Take a sigh of relief and you say, yay. And that puts that one at 11,565 also. Okay, now let's hold our breath and try to check my work one more time. Yes, So we feel like a big accomplishment because it's a little iffy down here when you're doing this, because here's the thing, there is always a possibility you could have a loss in a loss year. You would have a reduction of the equity, and so it wouldn't have been a plus years. But in a normal year where revenue exceeds expenses, this would be the format. You would have the net income would show up as a debit on the income statement and a credit on the balance sheet. But if you had a loss, it would be reversed. But I don't know that they're going to make you see that at this moment. But in the future, as you develop and go through more accounting scenarios, it definitely is a possibility that it could be a little bit different right down in here under the net income. But once you get to the balance place, and you, especially when you have this program and it shows you check my work, you're great, gold. So anyway, you guys are ready to do your homework. Thanks.